Morning, everybody. Well, there's only a couple of people logged on at the moment. We're a little bit early, so we'll just wait for people to join. Thank you to those that have logged on so far. We'll be with you shortly. Morning to those people that have just joined in the last minute or two. We're welcome. We're just waiting on other people to join. I'm going to give it a few minutes. We were expecting about 14, 15 people. So I'll just give it a couple of minutes for hopefully a few others to join, and then we'll kick off in just a minute or two. Well, I don't want to hold people up. So we are recording the session. I hope that's okay. And those that will circulate to be available for people who have been registered to join but have been unable to join. Thank you to those people that have logged on. My name is Paul Windmill. I'm the director at Myers Clark in charge of our charity and not-for-profit team. The purpose of today's webinar is to run through the key changes to coming out of SORP 2026 and also just share a few other observations from us at Myers Clark based on the work that we've been doing with charities recently. We've set aside an hour. I don't think it will take an hour, and please do chip in with questions, although I have allowed some time at the end to also run through some questions. I think in the usual way, there's not many of us, if you did feel brave enough to unmute and raise a question, that's absolutely fine. Or indeed just type it in the chat and we'll keep an eye on that as we go through. So to make a start, firstly, to talk about a quick overview of SORP 2026, which is the main topic of what we're going to talk about today. For those that have been following the sort of progress of the SORP, there was a consultation period last year. That's not a good start. I've just noticed a typing error in my first line there. It was actually published on the 31st of October 2025, not 2026. following that consultation period. Although luckily the next line is correct. It's effective for accounting periods commencing on or after the 1st of January 2026. So still some time away before it comes in. So effectively December 20, for most charities, December 2026 year ends will be the first year of adoption. Why was it brought about? Well, the SORP, for those that have been working in the sector for a little while, we'll be on to our third or fourth iteration of the SORP. So it is updated every so often. The headlines there, as it says, were to improve transparency, consistency, and accountability. I think the main point there is the consistency piece, to bring the SORP into line with aspects of FRS 102, which is the main accounting regulations for businesses within the UK. Alongside the SORP, they've published a summary of the key changes. We're going to talk about lease accounting, revenue recognition, and the tiering sort of system this morning. But I put the link there to the Charities SORP page, and if you scroll down on that page, you'll see a line which says summary outlining the changes to each module. Click here, and that takes you to this publication here, which is quite a good summary of the changes that have been made within sort of each area of the SORP, and whether it sort of categorizes or gives you an extent of the changes, where it talks about significant changes, limited changes. So for anyone who didn't want to read the full SORP, going to that document is quite a good starting point, I would say. As I say, we're going to talk about what we think are the main changes, and certainly the areas that have been flagged up as those that have significant changing. First of which is the lease accounting changes for lease accounting for leases, leases that you pay rather than rental income that you receive, I should say. The first point there is the removal of the distinction between operating and finance leases. So in the old days now, operating leases used to be just dealt with in terms of an expense in the profit and loss account and a disclosure of the commitment under that lease. And a finance lease was accounted for on the balance sheet. The main difference being, ultimately, are you going to own that asset or not? If you were going to own the asset, then generally it was a finance lease and you accounted for it on the balance sheet. What FRS 102 and now the SORP say is that most leases will now be recognised on the balance sheet as a right of use asset, and you'll recognise the corresponding liability. We think this is mainly going to impact property leases for the main part. As I said there, it doesn't affect short-term leases, which are leases of less than 12 months, or low-value assets. Unhelpfully, there's no definition of low-value assets, and that will have to be looked at on a case-by-case, charity-by-charity basis, essentially around materiality, and that brings a level of sort of complexity a little bit. The way the calculation is, the way the asset and liability are brought onto the balance sheet is a valuation based on the net present value of the future rent payments. Essentially, what does that mean? It means you look at how long is left to run on the lease, what the future lease payments or rent payments are, sort of X times Y, so length of the lease times the amount of those payments gives you the sort of main starting point. But then, because it's a net present value calculation, you are applying a discount rate. So you are discounting those future rent payments back to a value in today's money. So that essentially presents the first challenge or factor when looking at this. Getting the future value of the rent payments should be relatively straightforward. Getting the term of the lease should be relatively straightforward, and so therefore, what is the discount rate? The first place to look will be the lease, because it may give you an indication of a discount rate. In most cases, we think it probably won't. So therefore, you have to look at what discount rate is relevant for your particular charity. And the suggestions are that you look at what your charity, effectively the interest rate that your charity is either borrowing money at or investing money at. So you look at, for example, term deposits or deposits and say, what rate of interest am I receiving on that deposits? And that gives you your discount rate. So then you have a calculation of length, term of the lease, times the future value of the rent payments with that discount factor applied will then give you your net present value calculation. That comes in as the asset and the liability. You need to look at the term of the lease in terms of accounting for the liability is less than 1 year and more than 1 year. Then going forwards, what will happen is you will amortize the asset over the term of the lease. So if you have that, if your net present value calculation is £100,000 and you have 10 years left on the lease, that amortization is going to be £10,000 per year. That's what goes into your SOFA now as an expense rather than the rent payment. And the rent payments will, as I said there, pay down the liability. So they'll start to reduce your liability. So your starting liability in my example there of £100,000, if your payments are £10,000 a year, at the end of year one, your liability reduces down to £90,000. There's no requirement to restate the comparatives, as there sometimes is when new accounting regulations come into force. So effectively what that means is that the first year of adoption is going to look a little bit odd or unusual, because all of a sudden you're going to have an asset and a liability that wasn't there in the previous year. This may impact audit thresholds because the value of your gross assets is going to increase. We'll come on to the new thresholds as part of what we're talking about today. And it also, for a few charities, it may impact loan covenants. We may see this more in the commercial sector, but because some loan covenants have a calculation relevant to net current assets, for example, and because you're now going to have a liability for next year's rent payments within your current liabilities, your net current assets are going to go down. And so getting ahead of that calculation and talking to a lender, if relevant, I think is important, because we don't know yet how lenders are going to interpret or understand the impact of this. So those, I think, are the main points there on lease accounting. Moving on to revenue recognition. Again, this is, as with lease accounting, is to bring the SORP back in line with FRS 102 and apply a 5-step approach to exchange contracts. An exchange contract being where the charity is receiving income in exchange for the transfer of goods or services. And an annual membership being a good example. So an annual membership which gives entry to whatever it might be. So I'm paying my £100 a year, and in return that gives me entry into whatever it is. I'm receiving something in return for my money. This is different to a performance obligation within a grant contract, for example. So a performance obligation is not necessarily an exchange transaction, as I've said there. And I've used an example there where if a charity has received some funding to provide a specified number of meals for the homeless, the funder itself isn't necessarily receiving the benefit for that. So it doesn't fall into an exchange contract. Having said that, the performance criteria within that contract might still determine when and how the charity recognises the income, but that's always been the case. It doesn't sort of change as a result of this new approach. And just before we move on to the sort of 5 steps, just to say, non-exchange income largely unchanged within the SORP. It's just changed some of the definitions around. So previously, again, it's bringing it back to performance-related criteria, which replaces the old entitlement, probability of receipt, and measurement assessment that we would have previously carried out when looking at recognising income. So the 5 steps under the new model: firstly, you identify the contract with the customer or funder, identify the performance obligations. So as we're talking about there, is the charity providing something in return? So take my example of an entry fee. As I said, I'm paying my money over, and in return, the charity is allowing me entry into whatever it might be, gardens or something like that. You determine that transaction price, and then you allocate that price to the obligations. So I've seen this example, and I'll carry on with it in terms of the entry. So an annual membership, alongside providing entry, I might be entitled to a drink. I might be entitled to specific events. I might be entitled to other benefits as part of my annual membership fee. What the SORP says is where we need to allocate the price to the obligation. So that my £100 a year membership, the charity needs to allocate that to the different goods or services that form part of that annual membership. And then you recognise the income as the obligations are met. So an annual membership, for example, might assume a certain number of visits or it might entitle the user to a certain number of visits, or it might just be, as it says, an annual membership, in which case we'll be allocating the income evenly over the period of the membership. I think in a lot of cases, it's not going to impact many revenue streams of the charities as far as we can see at the moment. I think the performance obligation criteria is important, but what is the charity required to provide and to the donor? That's the important bit. And I think what we see anyway is within a lot of grant contracts, for example, that charities have, there are performance criteria, but it's service delivery rather than an exchange transaction. This is probably a little bit more tricky to understand compared to the lease accounting. So we'll probably, let's just see, we've got a question here. Would this apply to SLAs? It could do. So that's a good example. It very well could do. Again, it depends on who's. If we go back a step, sorry, let's go back one. I think the important bit here is an exchange contract is where the charity receives income in exchange for the transfer of goods or services. So who is benefiting? Who is the charity providing the service or goods to? If it's not the fund, so we're under an SLA transaction, may be more relevant to the paragraph here where we talk about there's a performance obligation, but the funder doesn't benefit. It's the beneficiaries of the funding that benefit rather than the donor directly. It's a little bit case by case. So I think that's definitely something we can look at on a case by case basis with individual clients, if that's okay. The other area I wanted to talk about is the new tiered reporting framework. And what we've brought in here is, or what the SORP has brought in here is this, and this impacts mainly on trustees report and also on cash flow statements. So it segregates charities into those particular tiers based on the level of their income. Tier 1, as it says there, is income below 500,000. Tier 2, wide band between 500,000 and 15 million. And Tier 3, above 15 million pounds worth of income. Slight technical point there is that it does, although it aligns with the Companies Act, small and medium, large company thresholds, where we're talking about cash flow statements, for example, although under the SORP, it talks about it's just required for Tier 3 charities, where they're the larger charities. If it was a charitable company, and for companies and charitable companies, they have 3 tests to meet: the level of income, number of employees, and the level of gross assets. So technically, a charitable company could be in Tier 2, for example, just based on income. But if it had more than 50 employees and gross assets of more than currently 3.26 million, it could still be a large charity and therefore require a cash flow statement. Very techie point, but just wanted to flag that up. I think most people are just going to be categorized based on the level of their income. Wanted to have a quick look about the impact of this on the trustees report. Within the SORP, again, and just refer you to the SORP a little bit, there's a good section within the SORP on the annual report. And within the section on the annual report, there's a very useful table which categorizes the requirements for the trustees report depending on what tier you're in. So it gives you, as we said there, all charities need to give a fair, balanced and understandable review of the charity structure, purposes, objectives and activities, financial performance and financial position. And the table within the SORP breaks this down into specific paragraphs for each tier. So that's really quite useful for somebody to go and have a look at. I've picked out a few items there that I think are relevant. Under the achievement and performance section, more of a focus now on impact reporting for those charities within Tier 2 and Tier 3. Under the financial review section for all charities, disclosure and talking about their reserves policy, and also the charity's own assessment of its position to be why it believes itself to be a going concern. And again, that's a lot, particularly the going concern section there is aligning with FRS 102. There's quite a beefing up of the responsibilities for trustees and directors around their own assessment of going concern. Plans for future periods, I think we've, as always, been there, but again, it's relevant to all tiers. And here, a sort of key change for the larger charities in Tier 3 to talk about sustainability, which again follows the sort of reporting in directors' reports and strategic reports for companies, now much more of a responsibility around sustainability for the larger businesses. As I say, that section within the SORP itself and the table 1 on page 25 of the SORP is quite useful, I would say, for a read in terms of each charity's individual requirements within the trustees report, depending on your tier. So what do we suggest? As I say, unless you are going to have a short accounting period or something like that, for most charities, there's time to now start looking at this because December 2026 will be your first reporting period. So picking up on the change in lease accounting, identify, review your leases, talk to us about those calculations, in particular maybe your discount rates. Have a look at your revenue streams for any performance-related conditions. As I said there, review the trustees' report requirements, and in any case, if you're in any doubt, consult us, and we'll be happy to look at things on an individual basis. Just while we're all together, and for the last however long we've got left, just wanted to pick up on a few other things that we've seen recently within the charity sector. First item there was quite a useful publication from the Charity Commission last year on the charity sector risk assessment, sort of highlighting, based on the Charity Commission's experience and interaction with charities, what they saw as the key risks to charities currently. I guess, not surprisingly, these will probably be familiar to some or all of you. Financial pressures. Charities are clearly not going to be immune from economic changes and impacts. And I guess the advice we can offer there, if you're not already, is make sure you have regular and accurate forecasting, so you can see the sort of trend that you have within the charity. And definitely that's one area where if you need some support, please reach out. We can help with forecasting for you. The other areas identified, and again, you'll probably will resonate with a lot of people: trustee recruitment, difficulties in finding relevantly qualified and suitable trustees, safeguarding, clearly a key area for those that it impacts, and cyber attacks. Just I think a useful reminder that charities, unfortunately, are targeted in the same way as other businesses in terms of cyber attacks. So making sure your online systems are suitably robust and defended is very important. The next point there about falling interest rates and the impact on cash reserves it's just a point there because it's cropped up in discussions we've been having with some of our clients in terms of they've built up decent levels of cash reserves. In recent periods when interest rates have been quite high, the return on the cash has been good and above the level of inflation. The point here is to keep an eye on as interest rates start to fall and inflation has been staying a little bit higher. Looking at that future, the impact of the future value of those cash reserves. Obviously, if the rate of inflation is above the value of the interest rate that you're receiving on that money, then the real value of the cash is actually going down over time. And therefore, can you reinvest that cash in other areas that gives you above inflation return? It's kind of one of the things that sometimes gets not enough thought, the impact of inflation. And so I wanted to raise it today because it's come up in a few conversations we've been having. I also wanted to point you towards some of our recent blogs specific to the charity sector. We try and keep, when a bit like with the cash one, where we have conversations with clients that crop up with more than one client, it sometimes becomes a useful article for one of our blogs. If you go to our webpage there that I've put on there and you search under charities, go to our blog page, search under charities, all of the charity blogs will come up. Recent ones include VAT and how it impacts charities. We've been doing some work with a few clients on very specific VAT implications for some of their income streams and things like that. Understanding designated funds is another good blog that we've written, again, based on conversations that we've had discussing reserves and reserves policies with clients and the use of designated funds as part of that reserves policy. And also another one I'd recommend is around CIOs. Again, coming out of conversations with clients where they were looking to convert to CIOs or considering conversion to CIOs. And then just finally, wanted to touch on the changes to the audit and income and examination thresholds, which come into play for accounting periods ending on or after 30th of September 2026. So similar, but not exactly the same time as the SORP. These are income thresholds in the main. So the income threshold for independent examinations are rising from 25,000 to 40,000. The income threshold for audits is rising from 1 million to 1.5 million. But just bear in mind that there is also a combined income and asset trigger that some charities may get caught by. So you will need an audit still if your income is greater than 500,000 and your gross assets are greater than 5 million. That was previously income of 250,000 and gross assets of 3.26 million. That's all I was going to touch on today. I hope that's been of use. If anybody would like to raise any questions, then please feel free to either now drop them in the chat or raise a hand, unmute, or equally, if anybody's got any specific questions, then please reach out. My email's there if you don't already have it, and we'll be happy to look at things on an individual basis. I'll leave it there just for a minute or two to see if anybody would like to raise anything. Otherwise, I would just like to say again, thank you for attending today. I hope it's been of use. We will look to do more of these in the future. If you have any topics that you would like us to cover that are relevant to you, if it's relevant to you, it's likely to be relevant to someone else. So drop us some thoughts on that, and we'll happily either look at those for future blog posts or indeed future webinars. So once again, thank you, everybody. I hope you have a good rest of the day, and we'll catch up with you all again soon. Thanks very much. Bye-bye.